This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I'll be showing you guys why I'm going all in on Oceania Healthcare stock. This is by far the largest stock that I have in the portfolio and makes up roughly 20% of my overall portfolio. So in today's video, I thought I'd perform a comparable analysis to show you why I'm so bullish on Oceania Healthcare stock. In this analysis, I'll go through 4 different categories. I'll be explaining why each of these categories are important to understand and how we can assess that to find the best company in this sector. So I've put a lot of time and effort into this video, lots of hours spent on research. So if you appreciate the work that I've done, please hit a like and subscribe if you enjoyed this video. And as always, I might be a little bit biased because I do own a lot of Oceania Healthcare stock, so make sure that you take whatever I say with a grain of salt and always do your own research before investing. This is not financial advice or recommendation for you to buy, hold, or sell any of the stocks that I discuss in today's video. But with that out of the way, let's get right into the video. So the comparable companies that I'll be talking about in this video are Ryman Healthcare, Somerset Group, Avida Group, as well as Oceania Healthcare. And the areas of comparison that I'll be talking about the portfolio of assets, basically what is the care beds versus units in the portfolio as a percentage, and we also have the development pipeline, capital structure, debt versus equity, as well as the valuation metrics of each of these companies. So the first category that we'll go over is the asset portfolio, and what I mean by this is how much of the portfolio is made up of care beds versus units. And the reason why this is important is because units are more profitable than the beds. So units include the apartment units, the villas, as well as the care suites. Any of these units that require an aura for a person to move into. So an aura is an occupation right agreement, and the resident will have to pay a lump sum for this aura in order to move in. So this lump sum, what the retirement operator will do with it is that they'll recognize 10% of that lump sum for the first 3 years, 10% each year as income. So for example, if I want to move into a $1 million villa, what I'll do is I'll pay the retirement operator $1 million, and the retirement operator like Ryman, Somerset, what they'll do is they'll take 10% each year, so $100,000 each year. And if you leave after the 3rd year, they'll give you back $700,000, and they'll bank the $300,000 in income. So that is the deferred management fee. It doesn't matter if you live in there for 3 years or 7 years, they will only charge you up to 30% of the aura. All right, so that is the deferred management fee, and that represents an extra source of income. The reason why care suites are more profitable than typical retirement village units is because the turnover for care suites is closer to 3 years, whereas independent living is closer to 7 years. So they'll benefit more from that DMF, the deferred management fee. As well as that, care suites might be eligible for the weekly DHB subsidy, and that DHB subsidy is between $1,000 to $1,200 per week. Now the beds are less profitable because they don't have that aura. You don't need an aura to move into this. It's basically just the standard weekly fee by the DHB, or in some cases the premium care beds, where you pay an extra amount per week to get a better service or a better feature like a room with a view or catered, I don't know, lunch or something special, right? So you pay extra fees for services, and that's why premium care beds are slightly more profitable, but the beds tend to be lower profitability compared to the units over here. So I know I've gone over the technicalities of DMF aura very quickly and very briefly. If you want to know more, check out my video on Oceania Healthcare over here. I explain it in more detail with the graphs and all that. So now let's take a look at the asset portfolio of each of these operators in the space. And as you can see over here, I've highlighted some having the highest proportion of units to care beds. And Oceania is red because they have the highest beds versus units. So that is actually quite interesting to see, and that makes a lot of sense as well, because Somerset is seen as the operator that focuses heavily on building units on independent living, whereas, Oceania are more focused on care. That aligns with my understanding why Oceania has the highest level of care beds. Ryman and Arvida are somewhere in the middle. Ryman also very well known for its care. In the retirement village space, if you're talking about care, it's usually Ryman or Oceania being the first, all right? So that makes a lot of sense, and that's also the reason why, Somerset has done so well in the past few years. You can see Somerset's share price has zoomed up 161%. Oceania is somewhere in the middle, and the other two, Ryman and Arvida, are lagging in terms of performance over the past 2 years. All right, so next let's take a look at development pipeline. The development pipeline shows us how many units are either planned, consented, or under construction, and this is an indicator of future growth and strategy. I have here Ryman, Somerset, Oceania, and Arvida, and you can see that Oceania is actually going to reduce some of the beds in their portfolio and increase the number of units. So they're going to decommission 316 care beds. What they're going to do is they're going to turn them into care suites. All right, so that is quite a huge move from Oceania Healthcare. The other operators have not so drastic changes. Somerset 3% beds, 97 units. Arvida 100% in units, and Ryman actually keeping quite a high level of beds versus units in terms of their development pipeline. Now you can see Somerset's development pipeline is 6,100 units. Ryman's about 6,100 as well, even though Somerset has half the market cap of Ryman. So despite having half the market cap, they have a similar development pipeline, and that does show Somerset is going to grow quite a lot going forward into the future, and you can see they can easily double what they currently have in their portfolio if they fully build out their development pipeline. Oceania and Arvida have similar pipelines because they are, after all, quite similar sized companies. And in terms of development pipeline, I really like what Oceania is doing, decommissioning some of their beds and developing more profitable independent living units as well as care suites. So that is a good sign from Oceania Healthcare, and that is also why I really like this pipeline. But if I had to go for another company, Somerset would be a good alternative because their current portfolio is already very clean, low percentage of low profit margin standard care beds, and very high percentage of independent living units as well as care suites. And going forward, they're going to build even more care suites. That's included in the number of units over here. So that's the development pipeline. The next category is capital structure, debt versus equity. So the question here is, how does a company fund its overall operations and growth? In times of low interest rates, more debt is beneficial because you take advantage of the lower interest rates, pay lower interest expenses. But having too high of a debt means you have a relatively higher risk of default and also limited options for future growth, because if you have too much debt, the bank wouldn't lend to you, and that way you need to raise equity in order to fund future growth. But having low debt might also mean that you're not maximizing shareholder wealth, because we know that the cost of debt is always cheaper than the cost of equity, well, most of the time at least. And so, if a company has low debt, that might mean that they might not be maximizing shareholder wealth. So now let's take a look at the net debt to assets and net debt to equity. And you can see Ryman is the highest on both measures. Ryman 25% net debt to assets and 80% net debt to equity. Oceania is the lowest in terms of both of these metrics at 13 and 30% respectively. So what this does show me is that Oceania is the lowest geared out of all of these operators. Ryman is the highest geared out of all. So in terms of Ryman's future growth, this is where I see this as a stumbling block, because Ryman has always prided itself in not having to raise any capital since it IPO'd, and I see that as an impediment for them to raise capital going into the future. So what that means is they'll either have to raise more debt, which is unlikely given that they already have so much debt, or they have to slow down their future build rate. They might not be able to acquire land if they see any opportunities, whereas the other operators might be able to, as you can see, Somerset and Arvida somewhere in the middle. But Oceania is well positioned, and the reason why this net debt to equity is so low is because they recently did raise 100 million earlier this year. So that has meant their net debt has dropped, and that also means that Oceania will have the ability to reinvest into the business in any medium-term opportunities to acquire new villages or land, or to build their existing development pipeline. And over here we see the return on assets for Oceania Healthcare being the highest at 2.92%, Avida is the lowest at 2.47%, and return on equity for Ryman is the highest, and Avida is the lowest at 6.7%. So the first thing I want to touch on is the reason why I think Oceania has the highest return on assets is because Oceania is seen as the premium service provider or premium offering in the space, because you can see that their villages are actually seen as a premium offering. They have a lot of sites in premium locations, at least in Auckland, and they have some nice penthouses as well. So they charge a premium because they are more boutique in terms of their village offerings, and I mentioned that before in the previous video. I visited one of their villages. So Oceania has the highest return on assets, and Avida might be seen as a cheaper option, all right? So they're not as efficient in terms of getting value out of their assets. Ryman has the highest return on equity, and that makes a lot of sense because they have the highest net debt. So as I said, too low debt, you're not maximizing shareholder wealth. And the other way also applies, the higher the debt, the more you're maximizing shareholder wealth to some extent. But Ryman Healthcare obviously delivering on that perspective. All right, 8.75, quite well above the other operators in this space. So now let's talk about the last category, which is valuation. So there's a saying, price is what you pay and value is what you get. And the idea is that you want to pay less than what it's worth in order to make money in shares, right? You want to buy undervalued assets. And the key two criteria that I like to look at, net tangible assets and underlying PE, in order to assess the valuation of these companies. How do they stack up? Well, Ryman is trading at the highest price to NTA at 2.34 times, whereas Oceania is trading at the lowest NTA at 1.27 times. And that makes sense because, Oceania is a relatively new player in the market. They are the newest IPO out of the bunch, Ryman being the oldest IPO out of the bunch. So that's why, Ryman had always traded at a premium on the market. But in terms of underlying PE, Somerset is actually trading at a higher underlying PE in terms of a trailing basis, of course, not future, but trailing. Somerset is trading at a higher PE than Ryman, and this is actually what I've mentioned before in my previous videos I've made on Somerset. I remember saying that, the upside for Somerset is when they are treated as a blue chip stock. When you're treated as a blue chip stock, when people buy, institutions buy, the valuation will go up. And that's what we've seen over the past year or so. We can see the valuation of Somerset catching up to Ryman, and that is not surprising at all. And going forward, Somerset will have higher future growth than Ryman, and that is actually justifiable why Somerset is trading at a higher current PE compared to Ryman at the moment. Avida is trading at the lowest underlying PE, and Oceania is trading very close to Avida at 21.26 times. Now, last month, before Oceania had a rally from about $1.32, it was actually the lowest underlying PE stock in this sector. So at that time, Oceania was a obvious winner in this case. They had the lowest underlying PE, had the lowest price to NTA. But right now, since it re-rated over the past month, Avida is now the cheapest. Do I think Avida is the best buy on this metric only? Maybe, but I think all the other factors considered, I see Oceania as a better play in this sector. They have a really good development pipeline. They have a portfolio that's, a higher drag from standard care beds, but over time we should see that change as they transition their portfolio into a more unit-focused portfolio. Based on return on asset and equity, Oceania is better than Avida in that perspective, and that does reflect the higher quality of assets that you get from Oceania. So this is why I'm going all in, or 20% of my portfolio in Oceania Healthcare. I see this as an undervalued stock in the sector, and I really do see this stock doing well over the next 5 years based on the current information that I have. And that might change in the next 2 or 3 years, or even the next year or next 6 months. So this is something that I'll continually assess over the future, and if things change, I'll let you guys know. But at this point in time, I do favor Oceania Healthcare the most in this sector. So let me know what you guys think about this sector, if you've invested in it or not, and let me know why, which one you're invested in. Always keen to hear your thoughts. As always, thank you guys for watching, and until next time, take care.